Welcome back to We Are Cosmic, your go-to channel for deep dives into cryptocurrency and market dynamics. Today, we're uncovering a movement that most casual traders aren't noticing, a quiet but massive shift in the XRP market that could change everything in 2026. Before you check the price charts or scroll through social media, let's zoom out and understand what's really happening behind the scenes. The speed at which XRP is disappearing from public exchanges is shocking. Tokens are moving into private wallets faster than we've seen in years. Headlines talk about volatility, but underneath the noise, a fundamental redistribution of wealth is taking place. Big players are quietly accumulating, locking away their XRP, and preparing for the next major price surge. If you think this is just a few whales making moves, think again. Over the last 48 hours, more than 25,000 new addresses entered the XRP rich list. These are not random small accounts. They span from retail investors to massive institutions. This broad accumulation signals that $2 is no longer just a price point, it's becoming a generational entry level. The circulating supply is shrinking, and every wallet entering this elite tier represents XRP that's effectively removed from the market. So why should this matter to you? Because this is not typical price recovery. It's a structural shift. The XRP ledger is expanding its foundation at lightning speed. Early 2026 saw the total number of unique XRP wallets surpass 7.5 million, a milestone few predicted would happen so quickly. With more wallets holding long-term, the market becomes more resilient. No single whale can crash the price as easily as before. Now let's talk psychology. Every investor entering the rich list is helping to form a new floor. Think of it as a fortress built by millions of hands. The $2 support level isn't just a number on a chart, it's a reflection of real confidence in the network. New buyers are not just trading, they are staking their claim in XRP's ecosystem. The entry requirement for the top 10% now is over 2,350 XRP, and for the elite top 1%, it's around 50,000 XRP. The barrier is rising every hour. This creates urgency. People aren't just buying, they're competing for a position in the network. Mid-tier investors, those holding between 10,000 and 100,000 XRP, are the fastest growing group, outpacing even whales in accumulation. These are serious holders, building a base that won't crumble during volatility. Meanwhile, retail participants with smaller wallets, between 1 and 500 XRP, are also growing, creating an organic, decentralized network that adds resilience. Here's the big picture. The XRP market is no longer just a trading game. It's becoming a structured ecosystem of long-term holders, from small fish to whales, all contributing to a more stable foundation. Supply is shrinking, demand is growing, and the $2 level is turning into a real psychological and technical floor. The quiet accumulation is building a stage for what could be the next major move in the XRP market. Now that we understand the quiet accumulation happening across the XRP network, it's time to look at the big players behind the scenes. Retail investors are stacking their positions, but a much larger silent force is at work: institutions. 2026 has marked a turning point for XRP. Institutional investors, from multi-billion-dollar hedge funds to asset managers, are entering the market at a pace that dwarfs anything we've seen before. These are not speculative traders flipping positions for short-term gains. They are mandated to buy, hold, and secure XRP, and their sheer capital is creating a structural supply shock. Every token they buy is removed from the circulating market, reducing liquidity and increasing scarcity. One of the primary catalysts for this institutional shift has been the success of spot XRP ETFs. For years, the market speculated about what would happen if Wall Street gained direct exposure to XRP. Early 2026 provided the answer. In the first 2 weeks of January, spot XRP ETFs recorded a staggering $1.7 billion in net inflows, effectively removing nearly 700 million tokens from public trading. For every token a retail investor purchases, institutions are taking 10 off the board. This is why the price shows such resilience even when the broader crypto market experiences turbulence. With this level of institutional demand, the order books on exchanges are being hollowed out. Traditional market dynamics, where a whale could trigger a cascade of sell-offs, are no longer as impactful. The available supply on exchanges is shrinking to multi-year lows, creating a scenario where even small buying pressure can push prices higher. The XRP market is now facing a classic supply squeeze. amplified by both retail accumulation and institutional absorption. The numbers tell the story. Exchange liquidity metrics show a consistent drop in XRP reserves on major platforms. Since the start of 2026, liquid XRP reserves have fallen by 18%, despite the price stabilizing above $2. This divergence signals extreme scarcity. When demand from sophisticated institutions meets a shrinking exchange supply, the natural outcome is an upward price adjustment. The quiet accumulation isn't speculation, it's a mathematically predictable shift. And this isn't limited to whales or institutions. Mid-tier investors, those holding between 10,000 and 100,000 XRP, are aggressively absorbing tokens that previously remained on exchanges. Their growth rate is 12% higher than whale accumulation in January. These participants are bridging the gap between retail and professional investing, reinforcing the foundation of the network. Smaller retail holders with 1 to 500 XRP are also contributing to decentralization and resilience. Collectively, this creates a multi-layered defense against market volatility. The structural impact is clear. XRP is transitioning from a high volatility, speculative asset to a scarce, high-demand digital asset with a firm floor. Every token moved to cold storage, locked in smart contracts, or absorbed by ETFs reduces available supply. Scarcity, combined with growing demand across all investor tiers, is forming the stage for the next price surge. This phase is also teaching an important lesson. Where you hold your XRP is just as important as how much you hold. Exchanges are no longer the default storage solution. During supply squeezes, withdrawals can halt, glitches can occur, and access to your funds becomes critical. Professional investors are using redundancy strategies, spreading assets across multiple accounts and platforms to ensure uninterrupted access. This is a crucial risk management technique that separates winners from those who get left behind. By combining institutional inflows, mid-tier accumulation, and retail participation, XRP's network is creating an unprecedented foundation of resilience. The $2 floor isn't just technical, it's a reflection of global investor confidence reinforced by both small holders and billion-dollar institutions. As we move forward, this supply squeeze will define the pace and strength of XRP's next market cycle. Now that we've covered the institutional wave and the supply squeeze, it's time to zoom in on the XRP rich list. This isn't just a leaderboard, it's a map of the new financial elite being built in real time. The rules for being considered rich in the XRP ecosystem have changed. Holding a few hundred XRP no longer puts you in the upper tiers. Ledger data shows that to reach the top 10%, you now need at least 2,350 XRP. The elite top 1% requires approximately 50,000 XRP. As prices rise, these numbers increase, creating a natural barrier to entry. Every hour you delay, the cost to reach these tiers climbs higher. What's fascinating is how different investor tiers are responding. Whales, those holding millions, continue stacking quietly, but the most aggressive growth is coming from mid-tier investors, the retail participants moving into the professional category. They are actively absorbing tokens that used to sit idle on exchanges, building positions that are hard to shake. Their accumulation rate in January 2026 outpaced whale stacking by 12%. This trend signals a new kind of financial power, smaller investors working together to secure a larger share of circulating supply. The psychology behind this accumulation is crucial. Investors aren't just chasing short-term gains, they are competing for rank within the network. The rich list has become a gamified system where position matters. The scarcity of XRP and the rising barrier to entry create urgency. Those who act early gain a strategic advantage, while latecomers face higher prices and reduced availability. Meanwhile, retail participation is booming. Small wallets holding 1 to 500 XRP have increased by 14%, bringing the total for this tier to over 6 million unique addresses. These diamond hands aren't flipping for quick profits. They are long-term believers in XRP's future. Their patience provides stability, absorbing sell-side pressure during volatile periods. Together with mid-tier investors and whales, they form a multi-layered foundation that makes the network increasingly resilient. This redistribution of supply is reshaping the market. Fewer than 500 wallets hold more XRP than millions of smaller holders combined, but that gap is narrowing. The network is moving away from centralized power controlled by a handful of whales toward a decentralized, diverse base of holders. This structural shift is why the $2 level is holding strong. It's supported not by speculation, but by millions of committed investors across all tiers. Competitive accumulation isn't just about wealth, it's about positioning. Every new wallet entering the rich list reduces the available supply for everyone else. The XRP ledger shows that each new entrant is effectively locking away tokens from the market, reinforcing scarcity. This isn't a temporary trend, it's a long-term re-architecture of the XRP ecosystem where timing and strategy are key to financial success. By understanding these dynamics, you can see why XRP's stability and resilience in early 2026 are unlike anything seen in previous cycles. The rich list isn't just a reflection of wealth, it's a reflection of conviction, strategy, and foresight. Investors who secure positions early are positioning themselves for the next major price movement, while those who wait risk being priced out. Now that we understand who's accumulating XRP and why, it's time to look at how scarcity is shaping the market. XRP isn't just disappearing from exchanges randomly, this is a structural supply shift, and the data confirms it. The first thing to notice is the declining liquidity on centralized exchanges. Since the start of 2026, liquid XRP reserves on major platforms have dropped by 18%, even as the price stabilized above $2. This isn't a coincidence. Every token moving to private wallets, smart contracts, or institutional holdings is effectively removed from the market. The fewer tokens available to trade, the stronger the buying pressure becomes. This is a textbook supply squeeze. On-chain metrics reinforce this picture. The XRP ledger shows over 25,000 new wallets joining the rich list in just a single month. Each of these wallets represents XRP that is now locked away, unavailable for short-term trading. This creates a vacuum effect on the supply side. Unlike traditional markets where tokens or shares can flood the market, XRP's structure enforces scarcity. Escrow protocols return unsold tokens back to long-term lockups, preventing oversupply. For example, in January 2026, Ripple returned 700 million XRP to escrow, neutralizing a significant portion of the monthly release. The result? Fewer tokens chasing more demand. When you combine retail accumulation, mid-tier growth, and institutional absorption, the market is facing a historically tight supply. This makes the $2 level not just a support line on a chart, but a psychological and structural floor. Every wallet holding long-term reinforces this level, making it increasingly difficult for short-term volatility to push the price lower. Retail psychology is a key factor here. Smaller holders, the diamond hands, are showing longer holding periods. On-chain analysis indicates that average holding periods for retail-sized wallets have increased to around 480 days, significantly longer than the 3-month churn typical of institutional trading accounts. This patience adds stability to the market, as these holders are unlikely to sell during minor dips. Meanwhile, mid-tier investors are competing for rank on the rich list. This competitive accumulation further reduces supply. Investors aren't just buying, they are staking their claim in XRP's ecosystem, building positions that become harder to liquidate as the network matures. This collective behavior transforms the market dynamics. XRP isn't just another crypto asset, it's becoming a scarce digital resource, with demand increasingly outpacing available liquidity. Institutional strategies also magnify scarcity. Spot XRP ETFs are moving billions of dollars into cold storage. Tokens used to back ETFs aren't traded daily. They're removed from circulation entirely. Combined with retail and mid-tier activity, this creates a multi-layered scarcity structure. The market is entering a phase where price movements will reflect fundamental supply constraints rather than speculative swings. This structural scarcity is creating a foundation for the next major move. With over 7.5 million wallets and growing institutional adoption, the XRP market is no longer dominated by a few whales. The network itself is distributing power across millions of holders, creating a decentralized, resilient system. The $2 floor is reinforced by data, not hope. Every accumulation, every wallet, every locked token strengthens this foundation. First, let's look at market sentiment. While mainstream crypto chatter often focuses on short-term swings, the XRP community is acting differently. Retail holders aren't panic selling. Mid-tier investors are actively climbing the rich list, and institutions are absorbing supply faster than anyone can sell. This creates a rare scenario, high demand combined with shrinking supply, which historically leads to strong, sustained price growth. Order book data supports this. Exchange order books currently show massive buy walls totaling over $400 million concentrated between $1.95 and $2.05. These orders aren't just casual bids, they reflect serious commitment from investors at all levels. In previous cycles, a few whales could trigger a cascade of liquidations. Now, with 7.5 million wallets, the network itself is defending the price floor. Let's talk numbers. Institutional inflows, primarily via spot ETFs, reached $1.3 billion in January 2026 alone, locking away nearly 700 million XRP. This is coupled with 25,000 new wallets entering the rich list. The result is a market where sell-side liquidity is drying up rapidly. The only way for the market to balance demand and supply is through upward price movement. The mathematical reality of scarcity is starting to drive price behavior. So, what could this mean for future prices? Analysts are projecting midterm targets ranging from $3.90 to an $8 breakout depending on ETF adoption rates, institutional inflows, and continued retail participation. These aren't speculative guesses. They are based on measurable supply, demand, and on-chain metrics. The more supply that leaves exchanges and enters long-term storage, the higher the potential price as competition for available tokens increases. Psychology is also a factor. Competitive accumulation is intensifying. Investors are no longer simply buying XRP. They are securing positions to maintain or improve rank on the rich list. This social and financial competition drives urgency and reduces hesitation, which amplifies demand pressure on the shrinking supply. Small and mid-tier investors are no longer spectators. They are actively shaping market behavior. This is why XRP's $2 floor is so important. It's not just a technical support, it's a foundation reinforced by millions of wallets, both small and large. The market is beginning to decouple from broader crypto volatility. While Bitcoin and Ethereum may fluctuate, XRP's combination of scarcity, accumulation, and institutional adoption is creating a new range of stability and upward momentum. Show music. But caution is still needed. High growth periods like this are also periods of risk. Exchange outages, technical glitches, or sudden regulatory changes could impact access to funds. That's why professional traders use redundancy strategies, maintaining multiple accounts across exchanges to ensure uninterrupted access. Being prepared and proactive separates winners from reactive participants. As we look ahead, the next leg of XRP's journey will be defined by these factors: supply scarcity, competitive accumulation, institutional adoption, and strong retail conviction. Together, they create conditions for significant upside potential while minimizing the influence of any single whale or isolated market shock. We've covered the accumulation, scarcity, rich list dynamics, and potential breakout scenarios. Now it's time to focus on strategies for positioning yourself in this new XRP market. This is where theory meets action. First, let's talk safety. With XRP liquidity shrinking on exchanges, where you hold your tokens matters as much as how much you hold. Exchanges can experience downtime, halt withdrawals, or face technical issues. If your XRP is stuck, it doesn't matter if you're on the rich list, the opportunity is lost. Many professional investors use redundancy strategies, spreading their holdings across multiple KYC verified accounts and wallets. This ensures access no matter what happens on a single platform. Next, consider long-term positioning. The quiet accumulation we've seen isn't a short-term trade. Retail, mid-tier, and institutional holders are securing positions for months, even years. The key is to adopt a mindset of patience. On-chain data shows that average holding periods for retail wallets are now around 480 days. Diamond hands absorb sell pressure, reinforcing the $2 floor and stabilizing the market. If you aim to capitalize on scarcity and institutional inflows, long-term holding is critical. Another strategy is monitoring the rich list and accumulation trends. The XRP ledger gives insight into who is buying and how the supply is moving. Mid-tier wallets, 10,000 to 100,000 XRP, are currently the most aggressive accumulators. Observing these trends can help you anticipate market pressure and identify opportunities before the broader market reacts. It's not just about whales anymore. These small fish collectively influence the market in significant ways. Institutions are also reshaping market behavior. Spot XRP ETFs are locking away billions of dollars in tokens, creating an extreme supply squeeze. Understanding these inflows helps you gauge potential breakouts and anticipate price targets. Every token moved to ETF-backed cold storage is a token removed from immediate circulation. This is why the $2 floor is holding so strong and why the next breakout could see targets ranging from $3.90 to $8 as scarcity intensifies. Risk management is equally important. Diversify across wallets and platforms to prevent a single point of failure. Keep a portion of your holdings in cold storage for safety. Track liquidity trends on exchanges. Watch accumulation data, and stay informed about institutional movements. Knowledge is power, and in a supply-driven market, it directly affects your results. Finally, engage with reliable information sources. Communities like our Cheeky Crypto Discord provide real-time whale alerts, technical analysis, and discussion on on-chain trends. Being proactive in understanding market shifts allows you to act quickly when the quiet accumulation turns into a loud breakout. The institutional wave won't wait for anyone, so positioning and information are critical. To summarize, the XRP market in 2026 is defined by scarcity, growing retail participation, and institutional absorption. The $2 floor is reinforced by millions of wallets and billions in locked institutional tokens. Your strategy should focus on security, long-term holding, monitoring accumulation trends, and risk management. The goal is to position yourself to benefit from supply-driven price movements while minimizing exposure to technical or liquidity risks. The takeaway? XRP is no longer just a speculative asset. It's becoming a scarce, structurally supported digital resource. The quiet accumulation, institutional adoption, and expanding rich list are laying the groundwork for the next major phase. Those who prepare, hold, and understand the dynamics will be the ones who succeed in this evolving market. With that, we've completed the full 6-part breakdown of XRP's 2026 market dynamics. From quiet accumulation to institutional inflows, scarcity, rich list competition, and strategic positioning, you now have a full picture of what's happening and how to navigate it. The window to act is narrowing, and understanding these fundamentals could make all the difference in the months ahead.